Welcome to our journey, a random walk down Wall Street by Burton G. Malkiel. Today we're delving into the world of financial markets, guided by the insights of a true maestro of the field, Burton G. Malkiel. A celebrated economist and writer, Malkiel has spent a lifetime decoding the enigma that is Wall Street, and his seminal work, A Random Walk Down Wall Street, is our compass for this expedition. This video is your map, designed to transform the complex labyrinth of stock market concepts into a clear, navigable landscape. We aim to make the daunting world of stocks, bonds, and investment strategies accessible to everyone. Whether you're a seasoned investor or just taking your first steps in the financial world, this journey promises to be enlightening. So, are you ready to uncover the mysteries of Wall Street, one concept at a time? Ready to dive in? Buckle up as we embark on this exciting journey down Wall Street. First up, what is this random walk we're talking about? Well, imagine you're strolling down a street, and with every step you take, you flip a coin. Heads, you step to the right; tails, you step to the left. Your path is completely unpredictable, and it's determined by the whims of chance. That's pretty much a random walk. Now let's apply this concept to the stock market. In the world of finance, a random walk suggests that the future direction of a stock price is as unpredictable as the toss of a coin. Just like the direction of your next step in our stroll, the future price of a stock is independent of its past. This means that all the information available about a stock, including its price history, is already factored into its current price. So, the next price change, whether it's an increase or a decrease, is purely random and unpredictable. But wait, does this mean that all our efforts to analyze and predict the stock market are in vain? Not exactly. While the random walk theory suggests that the stock market is unpredictable, it doesn't mean that it's entirely unmanageable. It simply implies that short-term changes are hard to predict accurately. However, long-term investment strategies like buying and holding diversified portfolios can still be effective. This theory also underscores the importance of an investment strategy that doesn't rely solely on predicting the future direction of stock prices. Instead, it encourages investors to focus on things within their control, like their investment goals, risk tolerance, and time horizon. So in essence, a random walk suggests that stocks take a random and unpredictable path. It's a reminder to investors that while the stock market may seem like a game of chance in the short run, a thoughtful, long-term investment strategy can still lead to success. And just like our coin-flipping stroll, it's not about predicting the next step, it's about enjoying the walk. Now let's tackle another key concept, the efficient market hypothesis. Picture the stock market as a bustling, efficient machine. It swiftly takes in information and adjusts the prices of securities, like stocks and bonds, accordingly. This is the essence of the efficient market hypothesis, or EMH for short. The EMH asserts that financial markets are informationally efficient. In simpler terms, this means that at any given time, prices in the market reflect all available information. So if a company's prospects improve, the market will immediately incorporate this new information, and the stock price will rise. Now, you might be wondering, how does this relate to the random walk theory we discussed earlier? Well, they're two sides of the same coin. If markets are efficient and prices reflect all known information, then future price changes must be determined by information that is not yet known. This information, by definition, is random and unpredictable. Thus, stock price movements should follow a random walk, meaning they are equally likely to go up or down. The EMH also has implications for investors. It suggests that it's impossible to consistently beat the market by buying undervalued stocks or selling stocks for inflated prices. Why? Because stock prices already reflect all information and expectations, so they're fairly priced. For example, if you hear a hot stock tip and decide to buy shares, chances are the market has already incorporated this tip into the stock price. Therefore, you're not getting a bargain, you're simply paying the fair market price. This doesn't mean that you cannot make money in the stock market, it just means that outperforming the market, especially on a consistent basis, is extremely challenging. So, the efficient market hypothesis supports the idea that the most reliable way to grow your investments over the long term is not by trying to pick individual winners, but by owning a diversified portfolio that tracks the market as a whole. Therefore, according to this hypothesis, it's impossible to consistently beat the market. With these concepts in mind, how should one approach investing? A question as old as the markets themselves. The answer, however, is not as elusive as one might think. It lies in understanding and adopting effective investment strategies. Strategies that align with the principles of the random walk theory. Firstly, let's talk about the buy and hold strategy. This strategy is as straightforward as it sounds. You purchase a stock and then you hold it. You hold it through the market's ups and downs, through its unpredictable twists and turns. Why? Because over time, the overall trend of the stock market has been upward. Despite temporary downturns, the market has consistently proven to recover and reach new heights. Therefore, the buy and hold strategy banks on the long-term growth potential of the market. This strategy aligns perfectly with the random walk theory, which suggests that short-term market movements are unpredictable and largely influenced by random news events. Thus, trying to time these movements or predict these events is futile. Instead, a wiser approach is to buy and hold, allowing the natural long-term upward trend of the market to work in your favor. Next, let's discuss indexing. This strategy involves constructing a portfolio to mirror a market index, such as the S&P 500. The idea here is not to beat the market, but to match it. By indexing, you're effectively spreading your investment across a wide array of stocks, thus reducing the risk associated with individual stocks. Again, this strategy is in sync with the random walk theory. Since the theory posits that it's nearly impossible to consistently outperform the market, why not simply aim to match it? By doing so, you're likely to achieve a steady, long-term return on your investment. Other strategies that align with the random walk theory include dollar-cost averaging, where you invest a fixed amount regularly, regardless of the market price, and diversification, where you spread your investments across different types of assets to reduce risk. Each of these strategies share a common thread, a thread interwoven with the fabric of the random walk theory. They all acknowledge the inherent unpredictability of the market, and rather than fighting it, they embrace it. They understand that the key to successful investing is not in chasing quick short-term gains, but in pursuing steady long-term growth. So, as you embark on your investment journey, remember to equip yourself with these strategies. Understand them, adopt them, and let them guide you. But above all, be patient. Because, as the random walk theory reminds us, the path to wealth is not a sprint, but a marathon. Remember, the goal is not quick riches, but steady, long-term growth. Of course, no theory is without its critics. As intriguing as the random walk theory might be, it's not without its fair share of skeptics and detractors. They question the very foundation of this theory and the efficient market hypothesis that accompanies it. Among the critics, one of the most common arguments is that markets are not always efficient. They argue that factors such as investor sentiment, behavioral biases, and information asymmetry can cause stock prices to deviate from their true intrinsic values. These critics believe that it is possible to beat the market by identifying and exploiting these inefficiencies. Another critique is centered on the assumption that price changes are independent and identically distributed. Critics argue that this assumption oversimplifies the complex dynamics of stock markets. They point out that stock prices can be influenced by a multitude of factors, including economic cycles, geopolitical events, and company-specific news. These critics believe that by understanding these factors and their potential impacts, investors can predict price movements and generate superior returns. Yet another critique questions the notion that past price movements cannot predict future ones. Critics argue that certain patterns and trends can be observed in stock price movements, and these patterns can provide valuable insights into future price movements. That said, the random walk theory is not meant to be the be-all and end-all of investing strategies. It is merely one approach among many, each with its own merits and drawbacks. Some investors might prefer other strategies such as value investing, growth investing, or momentum investing. These strategies rely on the belief that they can identify undervalued or overvalued stocks, or catch on to trends before other investors. So, while there are critics, many still find value in the random walk theory. Despite these critiques, the random walk theory continues to hold sway among many investors. They appreciate its simplicity and the idea that one cannot consistently outperform the market without taking on additional risk. For these investors, the random walk theory remains an important part of their investment philosophy. So, how do we apply all this to our own investment journey? Well, the random walk theory might seem like a complex concept, but in practice, it's quite straightforward. It's all about being aware of the unpredictability of the market. and making informed decisions based on your own unique circumstances. Firstly, understanding your personal financial goals is crucial. Are you saving for retirement, planning for a major purchase, or building wealth for the future? The answer to this question will guide your investment strategy. If you're saving for a short-term goal, you might want to consider more conservative investments. After all, the random walk theory tells us that it's impossible to predict short-term market movements, so it's best to minimize risk in this scenario. On the other hand, if you have a long-term goal, you might be able to tolerate more risk and potentially reap higher returns. Next, consider your risk tolerance. This is a measure of how much risk you're willing to take on in pursuit of your financial goals. Some people are comfortable with the idea of their investments fluctuating in value, while others prefer a more stable investment journey. The random walk theory suggests that over time, riskier investments such as stocks tend to yield higher returns than safer options like bonds. But remember, higher potential returns also come with a higher risk of loss. Finally, think about your investment horizon, or the length of time you plan to keep your money invested. If you have a long investment horizon, you might be able to withstand short-term market volatility and reap the rewards of long-term growth. On the other hand, if your horizon is shorter, you might need to be more cautious. One practical application of the random walk theory is the buy and hold strategy. This involves purchasing a diversified portfolio of stocks and holding on to them for the long term, regardless of short-term market fluctuations. According to the random walk theory, this approach should yield a return that's reflective of the overall market performance. However, it's important to remember that the random walk theory is just that, a theory. It's one way to view the market, but it's not the only way. Other theories and strategies exist, and they may be more suitable for your individual circumstances. Always do your research and consider seeking advice from a financial advisor if you're unsure. In conclusion, the random walk theory provides a useful framework for understanding the unpredictability of the stock market. It encourages us to focus on what we can control, our financial goals, risk tolerance, and investment horizon, rather than trying to predict the unpredictable. And remember, investing is not a sprint, it's a marathon. It requires patience, discipline, and a willingness to ride out the ups and downs of the market. So, don't be discouraged by short-term losses, and don't be tempted to chase short-term gains. Stay focused on your long-term goals, and make informed decisions based on your own unique circumstances. With patience and discipline, you too can navigate the unpredictable world of Wall Street. And that, folks, is a random walk down Wall Street. We've traveled through concepts, strategies, and critiques, all to better understand investing. Keep exploring, keep learning, and let your financial knowledge grow. Thank you for joining us on this journey. Until next time, stay financially savvy.